Hi, I'm Adrian. Welcome back to Premium Logic Lab. For the past 2 years, AI has been the fuel behind the market rally. It drove Nvidia, it drove software multiples, it drove cloud spending narratives, it drove speculative optimism, but something has changed. AI is no longer just a growth catalyst. It is becoming a risk factor. And that shift matters. Keycap 1. The narrative flip. Markets move on narratives before they move on numbers. For 2 years, the narrative was simple. AI equals productivity. AI equals growth. AI equals higher earnings. AI equals premium valuation. Now the narrative is splitting. Instead of, AI will lift everyone, the market is asking, who actually wins? And more importantly, who loses? That question is causing pressure in software and financial names. Because AI doesn't just create growth. It destroys margins. It compresses moats. It lowers switching costs. And it introduces competition faster than ever before. Keycap 2. Why financial stocks are feeling it. This is where it gets interesting. Banks, brokerages, trading platforms, they were never considered AI-threatened sectors. But now investors are questioning, if AI automates research, automates trading systems, automates customer service, automates underwriting, where is the differentiation? AI lowers the barrier to entry. When barriers fall, margins compress. Markets price that risk early. Not when earnings collapse, but when the possibility emerges. That's what we are seeing now. Keycap 3. The software repricing. Software stocks were priced on high growth, recurring revenue, high margins, strong moats. AI challenges that. If AI tools can replicate SaaS features rapidly, if new startups can build comparable products faster, if open source models reduce pricing power, then software multiples cannot remain extreme. This is not about earnings missing. This is about structural repricing. Markets are forward-looking, and when the future becomes less certain, multiples contract. Keycap 4. The macro layer. Now add macro on top. Rates are still elevated. Liquidity is not loose. ETF flows are selective. Positioning was crowded. When positioning is crowded and narrative shifts, volatility expands quickly. AI names were heavily owned. When doubt appears, exits become narrow. This is how momentum reverses. Not because AI stopped working, but because expectations became too high. Keycap 5. Is this the end of AI? No. This is not the death of AI. This is the maturation phase. Every technological revolution goes through this. Phase 1. Disbelief. Phase 2. Euphoria. Phase 3. Overpricing. Phase 4. Reality check. Phase 5. Sustainable growth. We may be transitioning from Phase 2 into Phase 4, and that transition is painful. Keycap 6. What should traders watch? Not headlines. Watch positioning. Watch volatility compression. Watch whether AI leaders hold key support. Watch whether financial stocks stabilize. And most importantly, watch sentiment. When AI becomes something people fear rather than celebrate, that is when opportunity begins forming. But not immediately. Fear needs to exhaust. Keycap 7. The psychological angle. This is where most traders get trapped. They anchored to the AI rally. They believed it was unstoppable. When the narrative flips, they hesitate to adapt. Markets reward flexibility, not loyalty to a theme. The question is not, do I believe in AI? The question is AI priced for perfection? Right now, markets are repricing that perfection. Keycap 8. Probabilities going forward. Base case, consolidation and volatility, 50%. Deeper multiple compression in weaker AI names, 30%. Strong leaders stabilize and resume trend, 20%. This is not about predicting. It's about mapping scenarios. AI was the story that lifted the market. Now it may be the story testing it. If you want to understand how narrative shifts drive price action before fundamentals do, subscribe. In the next video, I'll break down whether this AI repricing creates long-term opportunity, or signals a broader rotation out of growth entirely. Thanks for being here.